Ever wondered how JEPI compares to DIVO in terms of performance? Well, today we'll be comparing these two funds to see which one takes the lead in the investment realm. JEPI, or JPMorgan Equity Premium Income ETF, and DIVO, the Amplify CWP Enhanced Dividend Income ETF, both aim to provide investors with a steady stream of income, but they take different paths to get there. We'll be using a range of key performance indicators to assess these funds, including annualized return, standard deviation, best and worst years, maximum drawdown, and various risk-adjusted measures like the Sharpe and Sortino ratios. These measures give us a comprehensive view of each fund's performance, taking into account not only returns, but also risk and volatility. We'll also take a look at the expense ratio and dividend yield, which can significantly impact your net returns over time. Now, let's dive into the numbers and see which fund outperforms the other. To begin, let's look at the start and end balance for both JEPI and DIVO. Imagine, if you will, that you invested $10,000 in each of these funds. Fast forward a bit, and your investment in JEPI would have grown to $11,652. Not too shabby, right? But wait, DIVO isn't too far behind, with your initial investment swelling to $11,601. Now, let's talk about the annualized return, or the compound annual growth rate. This is a useful metric to understand the average rate at which an investment grows each year. For JEPI, this figure stands at a respectable 10.73%. DIVO, on the other hand, lags slightly behind with a CAGR of 10.41%. Remember to subscribe and comment on what funds you want me to review next. Now you might be thinking, that's it? JEPI wins? Well, not so fast. These figures give us a snapshot of overall performance, but they don't tell us the whole story. For instance, they don't account for the volatility of returns or the risk involved in these investments. To truly understand the performance of these funds, we need to consider other factors such as the standard deviation, which tells us about the volatility of the fund's returns. JEPI has a standard deviation of 7.64%, while DIVO's is slightly higher at 9.51%. This means that DIVO's returns can fluctuate more widely than JEPI's. Additionally, we must consider the best and worst years for each fund. JEPI had its best year with a return of 9.81% and its worst year at 6.11%. DIVO, in contrast, had its best year at 8.47% and its worst at 6.96%. So far, it seems that JEPI has a slight edge over DIVO, but the story doesn't end here. Let's consider the standard deviation, best and worst year performances, and maximum drawdown. Standard deviation measures the dispersion of a dataset relative to its mean. The higher the standard deviation, the greater the variance, implying more risk. For JEPI, the standard deviation is 7.64%, and for DIVO, it's 9.51%. So JEPI has a lower risk profile compared to DIVO. Now let's talk about the best year performance. This is the maximum return that the fund has achieved in a single year. JEPI's best year performance was 9.81%, while DIVO's was 8.47%. This suggests that in the best of times, JEPI was able to deliver a higher return. The worst year performance, on the other hand, represents the lowest return that the fund has suffered in a single year. JEPI's worst year was 6.11%, and DIVO's was 6.96%. This means that in the worst of times, JEPI experienced less of a drop in returns. The maximum drawdown is the largest single drop from peak to bottom in the value of a portfolio before a new peak is achieved. JEPI's maximum drawdown was negative 4.11%, and DIVO's was negative 6.01%. So JEPI had a smaller maximum drawdown, indicating less extreme fluctuations in value. In summary, JEPI demonstrates less variance in returns, performs better in the best of times, suffers less in the worst of times, and exhibits less extreme fluctuations in value compared to DIVO. This suggests that JEPI might be a more stable choice for investors seeking a balance of risk and return. Now, these are just a few of the many metrics that investors can use to assess the performance of these funds. It's important to consider all relevant factors before making an investment decision. Both funds have their highs and lows, but JEPI seems to have a more stable performance. To wrap up, let's look at the Sharpe and Sortino ratios, benchmark correlation, expense ratio, and dividend yield. The Sharpe ratio, which measures risk-adjusted return, shows that JEPI, with a ratio of 0.71, outperforms DIVO's 0.55. The Sortino ratio, gauging downside risk, also favors JEPI at 1.09 compared to DIVO's 0.84. In terms of benchmark correlation, JEPI again leads the pack with a correlation of 0.81, suggesting it moves more closely with the market than DIVO at 0.60. When it comes to costs, JEPI has a lower expense ratio of 0.35% compared to DIVO's 0.56%. Lastly, the dividend yield of JEPI is a handsome 7.32%, substantially higher than DIVO's 4.49%. In conclusion, while both funds have their strengths, JEPI appears to offer a more balanced performance with a higher return and less volatility.